The Federal Reserve's decision to raise interest rates in order to combat stubborn inflation is having severe consequences in many different countries across the globe. While increasing rates have done little to simmer down inflation, it certainly has been pumping the value of the dollar, the world's reserve currency, causing economic turmoil in other countries. The US dollar index, which measures greenback against a basket of other currencies, is up nearly 17% so far this year, hitting a 20-year high. Although the dollar has pulled back in past few weeks, it's not expected to meaningfully reverse course anytime soon. You might say, well, a strong dollar is a good thing, right? It's complicated. Let me explain. Before I do so, I would really appreciate it if you take a second and share the love by hitting the like and subscribe button. My name is Vitaly, and without further ado, let's dive into today's topic. Ever since the Fed adopted a hawkish monetary policy in response to the inflation dragon, which they created by the way, the dollar has been strengthening dramatically. As some of you may remember, at the beginning of 2022, the federal funds rate was near 0%. Fast forward 9 months, today the Fed funds rate is 3% to 3.25%. This rate hike campaign is undoubtedly one of the most aggressive since Paul Volcker's era, and it's having a profound impact not just on the United States, but the entire world. Economists forecast rates to reach 4% by the end of this year and as high as 4.5% in 2023. This move in interest rates inevitably made American investments more attractive to global investors, particularly fixed assets, as they now offer a higher return than most other developed countries, causing investors to flood into the United States, leading to more demand for dollar. While international investors who are shifting assets into the US and away from other developed nations may be good for the United States, it's not good for other emerging countries, which may become a big problem moving forward. Just like it was a problem in the 80s when the Fed Chair Paul Volcker implemented a policy of tight money, which included dramatically raising interest rates. The federal funds rate, which is the rate banks charge each other for overnight loans, was raised from 11% in 1979 to a peak of 20% in June of 1981. This led to a sharp increase in the value of the US dollar as investors began seeking out dollar-denominated assets. The strong dollar had a number of negative consequences for the United States economy, including reduced exports and increased imports. In order to address these issues, the finance ministers and central bank governors of France, West Germany, Japan, the UK, and the United States met at Plaza Hotel in 1985 and agreed to intervene in the currency markets in order to stabilize exchange rates. The Plaza Accord was successful in temporarily halting the appreciation of the dollar, but it also led to a significant decline in the value over the next few years. Could we see a Plaza Accord 2.0 this time around? Only time will tell. Aside from higher returns, today, investors are also worried about global recession, causing them to scoop up dollars, which are often perceived as a safe haven during turbulent times. So when investors buy more dollars, the value of the dollar goes up. And when the value of the dollar goes up, other currencies go down. A strong dollar has a mixed effect within the United States. On the one hand, Americans traveling abroad will find that their money buys more than it did when the dollar was weaker. This is especially true in countries whose currencies have dropped significantly against the dollar. In addition, a strong dollar makes goods imported from other countries more affordable. This is welcome news for American consumers who are facing high inflation rates. On the other hand, in countries like Nigeria and Somalia, the higher cost of imported food, fuel, and medicine due to a strong dollar has put a strain on already limited resources, increasing the risk of starvation. A strong dollar also has some drawbacks for the United States. One of the biggest drawbacks is that it makes exports more expensive, hurting American businesses that rely on foreign sales. Companies like Johnson & Johnson, Ford, and IBM. In addition, countries with weak currencies may be less likely to buy American goods as they are now more expensive, further reducing exports opportunities and making American companies less appealing. Countries with dollar-denominated debt are also feeling the pain. As the value of the dollar increases, so does the cost of servicing their debt. This is particularly troublesome for countries like Argentina, Egypt, and Kenya. The higher cost of servicing dollar-denominated debt has pushed these countries closer to a default. And in India and South Korea, the strong dollar makes these nations less attractive to foreign investors. The result is a perfect storm for economic difficulties, threatening to derail the progress made by many developing nations in recent years. Unless something is done to mitigate the effect of the strong dollar, the future looks increasingly bleak for many of the world's poorest people. Given the United States' position as a superpower with the world's largest economy, it's no surprise that policy decisions made in Washington frequently have far-reaching consequences. One way in which this is evident is in the dollar's status as the world's reserve currency. Because of this, multinational corporations and financial institutions all over the globe often use dollar to price goods and settle accounts. This is especially true for energy and food commodities commodities, which are often bought and sold on the world's market in dollars. And as I mentioned earlier, a significant amount of debt owed by developing nations is denominated in dollars. According to a study conducted by the International Monetary Fund, nearly 40% of all global transactions are done in dollars. Consequently, it's clear that the United States wields considerable influence in the realms of finance and trade. As countries around the world are feeling the heat of increasing dollar, could the pain be stopped? The short-term answer is no. The Fed is unlikely to change course on interest rates anytime soon, and as long as that's the case, the dollar is likely to continue its ascent. The Fed is overly occupied with issues at home, such as the raging inflation, and is unlikely to give much thought to the negative consequences its policies are having on the rest of the world. A coordinated dollar intervention similar to Plaza Accord is also unlikely, as the Fed seems unbothered. For now, countries across the globe must deal with the fallout from the Fed's decision to raise interest rates. The question is, how long can they hold out? That's all I got for you today, folks. If you made it to the end, I hope this information is worth your time. Stay safe and stay informed.